Single family or syndication? Which one's best for you? Stick around and find out.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. One of the many questions that we get often is single family or syndication, and which one is better for me? Right? We get asked that question a lot. So today what we're going to be doing is going through some of the differences, right, between those two opportunities. And Anthony, let's start this off by saying, right, we will tell you guys, there's not one that's typically better, right? They both have their pros and they both have their cons. And so really that is our objective today, is to lay them out. We're going to highlight some of those differences, and we might be throwing some of our 2 cents in there, right?
Yeah. I probably throw my 2 cents around.
Exactly.
You know me.
2.5 cents.
Yeah.
Anthony, let's get started. I'll start with some definitions. If you can, let's give kind of our listeners a working definition of what we're referring to when we refer to turnkey or single family.
What I would say with turnkey real estate, great place to start with real estate, because typically the biggest burdens of real estate are going to be the 3 T's, right? Having to deal with tenants, toilets, and termites, right? Nobody wants to get those phone calls or have to go collect the rent. Well, or even when you find the property, maybe you don't have the expertise or the time to rehab it and get it in order and find the tenant. Well, with a turnkey rental property, they take care of all that stuff. They do the rehab. They find the tenant. They collect the rent. So they handle all of the phone calls. So this is a very less touch than if you are managing it yourself. Okay, Cam, so why don't you share your wisdom about what a syndication is?
Syndication, man, that's a word that gets thrown around a lot. And when we have meetings, I often will ask someone, hey, have you heard the word syndication? And typically somebody's heard of it. And so a working definition of syndication is really just the pooling of investors' funds. And so there's investment opportunities that can be in the millions out there, and very few people are taking down those types of opportunities. And so what they'll do is they'll create a fund, and then they will solicit investors to put money into that fund. And so that pooling of money is a syndication.
We're going to kind of break them down into a few different categories. And the first one we're going to talk about are the barriers of entry. You want to explain the barriers of entry for each one, Cam?
Yeah, barriers of entry is just really the cost. Like, what does it cost to get into this one? And if we start looking at single family rentals or turnkey rental properties, typically the price range on a lot of those is going to be on the low end, maybe $100,000 to $150,000 for the price of the house. And so for what you need to have to kind of make that purchase is you need to have the down payment, some closing costs, and maybe some extra capital. And so we're going to round this out at about $25,000 is what we're going to say is what's going to be needed for you to get into kind of a single family turnkey rental property.
Okay.
And multifamily is a little bit higher. They've got a much higher barrier to entry. Typically, it's going to be about $100,000 is what someone is going to have liquid cash to get into that investment. A few times you're going to see a couple opportunities for maybe 50,000, but those are few and far between. And then the other barrier to entry that I would add that is a good descriptor here would be that there are certain qualifications, right? You do need to qualify for each one of these. For the single family, ideally you're coming in with the down payment and you're going to finance the remaining balance on that property. And so financially you do need to qualify with the lender. And so that's going to be one qualification. On the multifamily side is typically you're going to need to be an accredited investor. And so the accredited investor definition is you need to have $1 million in net worth, excluding your personal residence, right, is that you need to have a married couple can make $300,000 or as an individual make over $200,000 a year. So there is kind of some limitations that come along with looking at multifamily.
Okay, yeah. Cam, what about like time and energy it's going to take for each one?
Yeah. Time and energy for each one in this case is pretty similar, right? It's actually pretty minimal for both of them. If you look at kind of your long-term rental, single family, is that ideally you've got a management company in place, so there shouldn't be a lot of oversight. We are estimating maybe 30 minutes, maybe an hour per property per month, and that is a very generous estimation.
Mm-hmm.
And on multifamily, right, it is literally a set it and forget it, right? Ideally, there's nothing that you need to do on a month-to-month basis. So that would be the difference between those two.
One thing I will add, one thing people get concerned about is if they own a real estate property or rental property, that they have to evict the tenant. And fortunately or unfortunately, I've gone through that twice with one of my turnkey properties. So I can talk from experience. I spent zero time on it, right? The management company did the whole thing. They went to court and did all of that stuff. They didn't do it for free. I mean, I did need to pay them, and it really was not that much, but it just shows worst case scenario that the tenant had to be evicted and there was some repairs that needed to be done. So they took a video of the damage, sent it to me. They hired the crew. They did it all. I mean, so I just want to get an example of the worst case when we're doing time and energy.
Yeah. Awesome, Anthony. All right. So, Anthony, you got 2 points you're going to share with us. Let's start with maybe the risk. Like, what's the exposure that we're looking at when these two categories?
I think when we're looking for turnkey, you got a few risks. One is going to be the vacancy, right? If somebody is going to, you're in between tenants, and when you're in a multifamily, you might have 100 or 200 doors, right? If you're buying a turnkey, you're typically having one door. But really, if we're going to compare the two, since a multifamily or syndications need about 100 grand, so and we can buy a turnkey for 25. So apples, I would say, that we would buy 4, right? So then you got 4 doors. But still, the less doors, there's going to be vacancy. So we need to anticipate and plan for that vacancy. And also, kind of like I said earlier, there's a tendency to do some damage. So there's some additional resources that may need to be put in with a multifamily. The biggest risk, I would say, is having the appropriate management company, right? Because that is going to be super key, because they are literally running everything. But when we have these unforeseen expenses, when it's a syndication, typically there is a reserve fund, and part of what they had accumulated to pay for some of those those expenses. So rarely is there going to be a capital call where they're going to tell their investors to put more money in. But when we have turnkey, we are the only investor and we are the reserve fund. So if there is some vacancy or some repairs, or we need some more money, there's going to be a capital call, and we may need to put some more additional funds in.
Good point. We are the reserve fund. I like that. Yeah, that was good.
And another thing to keep an eye on, syndication, we're going to be a limited partner. Yeah. Meaning our risk is limited. If something happens and there's a lawsuit at the where that LLC or the apartment complex is sued, they can't come back after you. Now with the turnkey, in order for that not to happen, you need to put your property into a LLC, and then that will provide you that protection. What a lot of people do, they say they're going to put it in an LLC, but then they don't end up actually executing it. So there is a little bit more risk of a liability with a short-term, or I'm sorry, a long-term rental, but we can minimize that if we have a LLC.
Yeah, good point. Speaking of kind of protection or advantages, Anthony, can you point out some of the differences between or in the tax opportunities that they have?
Yeah, as both of these are buying real estate. So one of the advantages of real estate is being able to depreciate. So there is going to be that advantage is going to be similar for taxes. One thing that can be different, and I know we're going to talk a lot about control, but when you have multifamily, the management team is going to determine how and what we're going to depreciate. When when you own it, you can choose. And there's ways where we could spread out the depreciation, or there's also some ways where you can accelerate the depreciation. Oftentimes, we may be able to deduct the down payment in the year that you fund it. But so with the tax wise, they're very similar, but the difference is when on a turnkey, you make the decision on how you're going to handle the taxes. Also, another great thing about real estate is the ability to do what's called a 1031 exchange. And what that means is if you're going to sell this property and it has a gain, what you can do is you can roll that gain over to another like kind property. And in essence, we are deferring the gain to the future. With a multifamily or a syndication, it technically is possible. We could do a 1031, either getting into the syndication or really rolling it out. However, there's a lot more moving parts there. And so the management team may not allow it. And also, typically, to get the 1031 on a syndication, you may need to have your name on the deed or on some unique papers, which may move you from a limited partner to a general partner. So that part is kind of hard to quantify. But again, there's going to, and also, I think this is going to be a reoccurring theme, right? In between the two, the syndications, things are laid out by the general partner. You can't really have much say, but in the turnkey, you are the partner, so you can make those determinations. Now let's talk about maybe what a lot of people are looking for. What about expected returns?
Yeah, expected returns when you're looking at kind of single family rental, right? Cash flow is king, right? Most of the time people are entering into that investment opportunity, and a lot of times you hear that appreciation is really just icing on the cake. I would say a lot of times someone's expected return in a turnkey is going to be anywhere from maybe 6 to 10% kind of cash on cash. And some of those returns have come down a little bit over the years. But I will say expected returns, right, when you're looking at cash flow is, again, right, we've talked about this all the time, but with single family rentals is that you do need to take in the entire equation, right? Not just focus on cash flow. We've talked about that a ton. But if we transition and we look over at multifamily, a lot of times multifamilies, what they're trying to do is they're trying to come in and add value. And so what they do is they try to buy a distressed property, they try to improve it, and then they increase the rents slowly over time. And so appreciation, right, is kind of what they're going after. If you were to look at kind of the timeline of returns, I would say that kind of single family rentals is immediate, right? You go, you close, you get cash flow month 1, right? Month 2, and then hopefully pretty consistently thereafter. Don't have too many vacancies, right? And then if you look at multifamily, there could be a slow start, right? Is a lot of times I've had clients that have kind of put money into a deal and they have waited. There's been a kind of a waiting period for them to raise funds. And then also for them, when they do acquire the property, there is also a waiting period when they actually need to improve it and then slowly raise those rents. And so there could be a little bit difference in those kind of the expected or stated returns on multifamily. When you look at a lot of those deck presentations is going to be maybe a 6 to 7% preferred rate, and then maybe another 7% or so kind of on the back end when they're exited anywhere from 3 to 5 years.
Okay.
Yeah. Awesome, Anthony. All right. So we've looked at a bunch of these, but what does this look like on the exit strategy for both of these opportunities?
Okay. I'll say whenever we're buying an asset, that exit strategy is crucial because a lot of times we have anticipation. Hey, I don't need this money for a long time. Maybe this is for retirement. I'm not going to need it. Sometimes life happens, right? Either something happens to you individually, or maybe the asset is not performing like you want. Now, with the turnkey, again, that exit strategy is going to be up to you. You know, you can sell. I mean, in this kind of example, we're like holding 4, right? To be comparative. If you're in a crunch, maybe you sell 1 or 2. Right. So we have that flexibility, or also you can leverage against those policies. You could do either a cash out refi, or maybe you can add a HELOC so you can go around, turn around and maybe and get access to the money. As I'd mentioned earlier, 1031 exchanges are easier to do when we're doing a turnkey. Now, with the multifamily syndication, again, it's not up to you.
Mm-hmm.
There's typically, it's kind of predetermined or estimated on what the exit strategy is going to be. I've seen them where sometimes they exit sooner, sometimes they're exiting later. So you have to be fluid and just understand that things may not go as planned. Now, if you do say something happens and you do need to exit out before the syndication has intended to, oftentimes there are ways like, okay, if you need to get out earlier, you need to have some sort of hardship.
Mm-hmm.
And that has to be approved, so it's not automatic. But typically, how they're going to value what you get on the exit is going to be, you're going to take a little haircut. And in part, in a way that you should, because if everybody's agreeing to be in this for the long term, but you want to change it, I mean, we don't want, it's not fair to hinder the partners who are staying in.
Well said. Yeah. I have one point. I was going to jump back up there. I don't think I was totally fair when I said kind of the expected returns on multifamily, right? I said there could be a slow start, but in all fairness, there could be an early exit.
Yeah.
Right. So, I mean, you could get 3 years into it. Maybe they were planning for a 5 to 7 year exit. And in year 3, they exit because it's a great market. They will come in and improve things quicker. So, right. I don't know if I was completely fair on that one.
No, you probably weren't.
Probably not. I'm biased.
Now, Cameron, from this podcast, we know you got a passion for many things, right? The Golden Girls,
Hey,
The Notebook,
it's good writing.
Paul Mitchell,
Mm-hmm.
right?
Mhm.
And having control,
Mm-hmm.
right? So let's talk, Cam. What are some of the differences in control of these two investments?
That's what it comes down to, right? Is at the end of the day, we've alluded to this already throughout. And when you lay these side by side, is the first thing that jumps out at you is the amount of control that you have in that scenario. I forget the saying that you said earlier because I really wasn't listening to you talk. But right, what it means is that, you know, when you look at single family rentals, is you are the guy, or the woman, right? You're the one that is making the decisions on that investment, on what exit strategy you're going to be doing. There's no input, right? Somebody can give you advice, but you're the one making the decision. When you look to multifamily and you get into those syndications, is you're just along for the ride, right? Somebody else is making those decisions and you're subject to those decisions for better or worse. And so, right, personally, I'm not a big fan of kind of that scenario. So, right, if I were to lean one way or the other, I'm a bigger fan of single family rentals. How about you?
What I would say, well, for me, I kind of view the difference is you going a turnkey, you're buying an asset, and with a syndication, you're buying an investment. And I know those are very similar terms, but you own that asset, you own and control it. You can determine a lot of the exits or what happens with that. And again, you own and control it. But with a syndication being more like an investment, you're handing over your money with an expectation of some return. So what I will say, personally, I like to own these assets. I'm in it for the long term, and there's a lot of advantages of owning real estate, and I'm a big fan of control. So ideally, I like to be able, a bigger fan of owning an asset than an investment. However, that's just us, right? Depending on your situation, like a lot of it depends on your comfort level and your time and
Education,
how you feel about control.
Yeah.
Right. If you're a busy W-2 and I think that the syndications can be a great place for you to put your money. I'd rather you do that than in any sort of mutual fund. Right. But if we're kind of trying to become investors and have that passive income more than the monthly expenses, I think we need to be buying assets. So that's going to take some more time. We got to get educated. We need to learn, but I think that time you will be well rewarded for that time of the investment.
Part of us going through kind of these highlighted points is because we do get a lot of conversations about, hey, which one's better? Or somebody calls in and they have an idea of what they want to do, right? If they're not doing it already. And a lot of times people will come across syndications and they look at one facet of it, really the passivity of it, right? Is how passive, how little time you need to put into it. And that's the biggest one that they take into consideration. Maybe they don't look at some of these. And so that's really what we're trying to do today, is highlight some of those that maybe you guys haven't thought about. But really, when someone calls in like that, typically what we're going to do is we're going to take it back to our hierarchy, right? Our hierarchy of wealth is tier 1. We want control, certainty, and collateral. Tier number 2 is where we're going to kind of look to invest in businesses and real estate. Tier 3 is kind of where we would typically classify syndications. And in tiers 2, we're going to retain the most control that we can, right? So we're going to oversee that entire process. When we move up to tier 3, if we need to, that's when we start to give over a little bit of control. And so we'd stick that up there in tier 3. And a lot of times people hear passivity and they try to jump from tier 1 all the way up to tier number 3, right? And it's best if we kind of work our way up. So thought I'd throw that in there.
Yeah. Well said, Cam.
Yeah, absolutely. You're welcome. Yeah. Awesome. All right, Anthony, anything else you want to share before we wrap this up?
Well, one thing I would like to add, if you have more questions about what asset class is best for you or how this whole infinite banking thing works, get on a call with us. 15 to 30 minutes. And let's we can either talk about IBC or some assets, and maybe we can point you in some right directions, but love to hear from you. And also what I'd be interested to hear, because I know this is on YouTube, I'd like to hear what your thoughts are between, do you like syndications better or turnkey rental properties?
Awesome. Great, guys. Hopefully this was a good overview of some of the differences. And then maybe we were able to point out some of the things that maybe you guys haven't thought of or we're kind of milling over. So hope you guys enjoyed this episode.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.